Good morning. Good morning to you all, and welcome to the fifth conference on fixed income by Vontobel. The title is Income Take Credit for It. All investors today are interested in rates and rates outlook. They are interested in yields. So we closed 2017, which performed very well. We started 2018 in a very successful manner, and we cannot but annualize yields achieved so far. There are some people who are making pessimist forecasts. It has been for the past 5 years that we have been organizing this conference. Here we have our best managers, because at the end of the day, the first objective for any investor is to get a return. How can we interpret such a need? Today, Mr. Francesco Tarabini Castellani, who is head of global sales fixed income, will be updating us on the fixed income boutique, which has been growing over the years. He'll be speaking about the experience, the skill of our professionals. Thanks to Monder Betayab, who is the head of credit, we'll be speaking about the bond market outlooks for those who were lucky enough as to attend our previous fixed income conferences and followed Monder Betayeb's advice must have achieved very interesting performances, because it is very interesting to listen to what he has to tell us about the different scenarios. He will be showing us something very special. Following him, Christian Hantel, who is our specialist on investment grade bonds, global bonds. And then the other segment of income is emerging country debt. We come from a period of time when the emerging market has grown, but there is still room for growth, for good performances. There are special risks due to the policies of central banks, and we'll be tackling these topics thanks to Luc Dorch, who is the head of emerging market debt and also the head of our emerging country franchise. Last but not least, thanks to Wouter van Overveld, will be considering a different way of investing in emerging markets, the trading, which is a new frontier, which is very interesting indeed. A technical advice: you can ask questions during the presentations by sending an email message to this address or through WhatsApp. At the end of the presentations, I'll be reading these questions and I'll be addressing them to the individual managers. There is also a Wi-Fi connection, Vontobel. No password is required, so no justification. You must send us your questions. Now I'd like to ask Mr. Francesco Tarabini Castellani to take the floor. Thank you very much. Thank you, Matteo. Thank you, Matteo, and good morning to you all. This is the part of my job that I love. This is the reason why, after 20 years, I'm still here working with Vontobel. It's a great pleasure for me to be here in Milan, a country, a city and a country where I'm not very often. But Italy is the country that helped us to build our fixed income division. And if in 2011 we started launching a boutique of fixed income, which was based on 5 or 6 managers managing 7 or 8 billion in Zurich. Let's the approach was, let's check the track records in the specific asset classes. Let's try and hire them, and let's allow them to do what they have done so far so that they can replicate their success stories. Those who there are rewarded. And I must say that these results have been much better than we expected. Today we have 30 billion assets under management. We also bought 24 asset management in London that has been growing in an incredible manner thanks to the UK customers, and we also opened an office in New York. So 42 managers between Zurich, New York, and London, and 7 investment franchise. We can definitely be considered a fixed income house which is well structured, and the power comes from performances, because performances, today are key. Here with us, we have best of our managers for the income approach. Income has always been used in the past years and is still very much up to date. We have Mr. Betayeb, who has been following us for the past years, since 2010. He will be convincing us on why we should be investing in fixed income. And then we also have Luke. Thank you, Luke. We have been following a meeting together. He's one of the best managers. He's number one for emerging market currencies, 5 stars, morning stars, top performance. And today we are also here to speak about 2 new strategies, 2 new trades. Like 5 years ago, we were the ones to relaunch the emerging market on hard currencies. We have the emerging market corporate and global corporate, which are underinvested both worldwide and Europe-wise, and they're more interesting even than the first 2. So plenty of attention to this aspect. And here we represented these 5 trades. On the left, we have the carry income yield. You see the yield generated by the trades from 1/4 of the Euro corporate up to 7% of the emerging market corporate. And we tried to draw a line between 2 different universes, developed and emerging markets. And the reading key is the governance level. Governance will be dealt with by Wouter, and this shows to what an extent governance is advanced in a market such as an emerging market or a developed market. And also at a corporate level, our agenda is very intense. So now I leave the floor to Monder, who will be introducing his scenario.
Thank you, Francesco. So good morning, everyone. Thank you for coming. We have a lot to go through this morning, and we're going to try to simplify it. The themes for this year is that basically, and I've heard it in the audience a little bit early on, people might still be afraid that inflation comes back. And if inflation comes back, of course, that's negative for government bond yields. We're going to tell you why this is not going to be the case, because we have some fundamental changes in the vast exchange system that we all operate in. And we have fundamental changes simply because of this machine. Can you imagine? The iPhone. So we are in a revolution, in a digital revolution, and because of that, we can procure anything we want, whenever we want, but the important thing is it's always going to be cheaper. Okay? What we buy is cheaper today than it was in the past because of this machine. So that's an important theme. So the takeaways will be inflation should stay relatively benign, and we'll explain why. And because of that, the environment, the investment environment should stay relatively attractive, because at the end of the day, to sustain a little bit of economic growth, the central banks will be very careful and will remain quite accommodative in our view, and we'll go into that. So is it still time to invest in corporate bonds and emerging bonds? The answer is definitely yes, to achieve income. Income is scarce these days, so these two areas are still quite attractive to invest in, despite where we are in terms of spreads and yields. Government yields are likely to stay low for much longer. And really, we'll also tell you a little bit what differentiate emerging markets and corporate credit in developed markets, which is quite interesting. It's a novel idea. So we'll give you also some examples as to income solutions, and then we'll wrap it up, basically. So investors usually don't factor in the effects of technology in their investments or in their investing activities or styles. This is key, and we'll show you why. We are in a new revolution, and typically a revolution lasts at least 30 years. That's only the beginning. And the end result of this revolution is that we're better connected, the world is clearer and more transparent, and the world is cheaper. Okay? I don't know how many of you used their iPhone this weekend, either to call an Uber cab, or to pay for a coffee, or to buy something that you've seen in a department store, but you can get it cheaper thanks to this machine. You type in whatever you like, and then if Amazon has it, Amazon has your details, you can buy it cheaper. So because you can buy things cheaper, inflation is going to stay relatively low. That's basically the message. And it's going to be cheaper and inflation stays low because one of the key takeaways of this conference is that you should really understand that companies today, they have lost their pricing power. They're price takers, they're no longer price makers. That's a very important notion. Okay? So I have a clip here which is extremely interesting, and the last bit is perhaps more interesting. It's about pricing. And we see that companies will have to adopt new, how can I say it, a new approach to pricing, and even institute dynamic pricing to be able to maintain, a little bit of margin. So this is quite interesting. And the world is really changing. I mean, yesterday was a news which I thought was quite interesting. And in the end, perhaps it will translate into cheaper products as well. Amazon created new supermarkets in the US, okay? And apparently, it's like you go into a metro station, you go with your iPhone, and Amazon has all your details to bill you, to send you the bill. You swipe your iPhone at the entrance, you buy anything in the supermarkets that you want, and then you just leave. You don't go to the cashier to pay. Amazon will basically debit your account automatically, depending on what you bought. This is quite amazing, isn't it? I mean, if you buy a salad, how does Amazon know that you bought that salad and it's that price? But actually, it is happening. So this is quite interesting. So the message in the end is that it's going to be a cheaper world we operate in this vast exchange system. And really, I invite you to watch this clip that I have. It's quite interesting. And yes, please go ahead. And it's Amin Tourani.
All these technologies also have a downside. Have a look at this video, and we'll discuss.
Today,
I would like to talk about
change.
change. Because
Change is
what we are
looking for.
and
We have
changed.
Absolutely everything.
Mind blown.
we're changing the way
people
People.
Communicate.
we've been changing.
the way the world is
Connected.
Connected.
We changed the way
People are sharing.
Stuff.
we build
Incredible.
exciting
amazing products and incredible devices. But honestly, the biggest
Change.
change
Of all.
is we
Make people give us all
their data.
Why?
because
We told them our
amazing products
are
for free.
but in fact all this will cost
them the most important
thing their data.
The journey has just started.
The good news is that
Today,
We know everything
about what
everybody. We will
be using
all this
information
data
to make them
awesome
Incredible.
a lot of
money.
money.
and it should be shared across government.
I was hoping you're going to like that.
Here's another way that value is being created, and this is a bit counterintuitive. I'm going to play a song for you and then pose a question.
The traffic jam down on the ground, like they need to know we're mad. Please, mother, drive me again.
All right. Who wrote that song? An AI did. A machine wrote that song. I couldn't tell. So Sony has a research and development lab where they fed 13,000 songs to an AI. They made the poor thing listen to 13,000 songs. And by the end of it, the AI could generate music. And in fact, this year they're set to release an entire album that the machine has created. So this is a mode of value creation that bypasses humanity altogether. Now the question is, are we prepared for that? Moving on to the next P of the 7 Ps, this is the world's most famous graph. Supply, demand, the intersection gives us what? Price. Not anymore. Not anymore. Thanks to the fact that the marginal cost of supply, the cost of creating one more unit of product or service, has gone down, some would argue all the way to zero, you can price discriminate. And the entire area under the supply curve is beginning to be serviceable. That means you should dynamically price your product or service. And these are some of the platforms on the web that started experimenting with this for the first time a while back. They got into hot water because nobody wants to pay a different price. But today, very few online retailers do not price discriminate. The most important message here is to know your customer. But what do you do when you don't have perfect information about their purchasing propensity? There are a few approaches you can take with dynamic pricing. Direct auctions, of course, work. Reverse auctions also work. This is where you start at a high price point and tick the price down, or start at a low price point and tick the price up. Combined with limited supply, you can help the market clear itself at the right price point for each purchaser. But my favorite is the following. Imagine walking up to a shelf in a retail store and the prices are updated. How annoying would that be? In fact, there are startups that are working on affluence detection based on what you're wearing and how you're walking. So watch out, take some classes.
So these people have really changed the world and changed the way we purchase things. And really the key message is that really products are going to be cheaper, they are cheaper, and they might get cheaper. So inflation, please don't worry about inflation. You know, it's probably going to remain benign within a range and not be too much of a problem, because really this new technology is quite disinflationary. Now, to put things in context and the evolution, throughout time, we've seen many revolutions. And the first one was the Industrial Revolution in the 1900s, basically linked to the Victorian era. That revolution lasted 60 years. Then it was followed by the age of distribution. This is when the American middle class started emerging. They needed to purchase quite a lot, and basically companies needed to organize themselves to make sure that they reached, those potential clients. Today, also, we can compare a little bit to our era today to the age of distribution, but the distribution has changed, and now the distribution is through this, which is quite amazing. In any case, the age of distribution, that revolution lasted about 30 years. And it's a nice evolution when you think about it, because then we moved on into the age of information. The age of information was when a company used to gather data to gain a competitive advantage, data on their customers. That data was proprietary to that company. It didn't share it with other companies. So that was a competitive advantage. And the end result of that competitive advantage is that it permitted the companies who gathered the data to really price their products accordingly and to be able to make good margins. Okay? So this information was not shared. And then the next stage, of course, today, it's the age of customer transparency. All this data, which represented a competitive advantage in the past, no longer do so, because everything is shared today. Everybody knows everything about us. And the companies, in essence, have lost a little bit their competitive advantage. So that makes sense. And it makes sense that they have more difficulties basically pricing their products the right way. Yeah? So this is a nice evolution. And then it shows also that, typically a revolution or a change lasts about 30 years. And the iPhone was just introduced about 10 years ago, and we've been using, the iPhones more actively today for the last, let's say, 3-4 years. So this revolution, as the people who we've seen in the clip said, this revolution is just starting. So really, inflation should stay relatively subdued and should not be too much of a threat, because one of the key takeaways, and remember that, is that really the companies have lost their pricing power. Okay? So today, more people use those digital means. I mean, in the European area, towards the end of last year, about 44% of people used to purchase things through the internet. And actually, the statistics on the iPhone are not available, but it's increasing all the time. So the end result of using this technology is that, it puts pressure on pricing and margins. And then, it has an effect on inflation. Inflation is unlikely to run away. It might increase a little bit here and there, trade within a range, but it will not go basically back to where it was in the past. So this is an interesting loop, and we're trapped by this loop, basically. We've talked about weak pricing. When a company has no longer its flexibility to basically price their products as they want, they have weak pricing, but the end result is that they invest less. Okay? With weak pricing, and when you invest less in CapEx, you're not going to basically pay your employees more. So wage growth is a little bit stuck, and wage growth and salary increases, even in the US, have been stuck for the last 4 or 5 years. Wage growth in the US is between 2.2 and 2.7%. It's within a range, and it hasn't moved that much. Yeah? But when people receive less cash, and or do not receive salary increases, they tend to spend less. Okay? And when you spend less, companies make less money, and they're less willing to invest. So we're cut into this loop, and to get out of it, it's quite difficult because of the new technology that we have. And that's why I said at the beginning of my speech, investors should factor in the effects of technology a little bit more, when they think about their investments and, when they think as to how the world could develop. So in the end, really, wage inflation and spending growth is going to stay dampened and subdued. And then it's a challenge for the central banks because, yes, we have a little bit of growth, 2.2%, it's nice, but it's still a little bit fragile. So to maintain that growth, the central banks have an incentive to keep rates relatively low and to maintain basically an accommodative monetary policy to basically spur a bit of economic growth. This is a chart I really like because it summarizes a little bit what I said in a diagram. It was developed by the Swedish Central Bank, and in Sweden they have low inflation. And basically you have two components in that chart. You have in yellow basically is the digitalization effect, and in blue it's the automation and robotization effect. And both legs end up towards lower inflation. With digitalization and the iPhone, basically you have increased competition. We can buy stuff that we want, perhaps not at X shop, but at Y shop for a discount of 20% thanks to that. That's really tough competition, I can tell you that. And then, the companies, to be able to survive, they don't increase their prices that much. So they can't really pay their employees more. So in the end, it leads to lower inflation. And automation is the same. Robotization is the same as well. Because when you automate and robotize and digitalize your processes, you get rid of jobs. You get rid of employees, sorry. And when you get rid of employees, the employee pool that is available grows. And when people want to hire, they have a bigger pool. So they offer less wages and less salaries to attract people than they used to in the past. So these people will spend less, it lowers their costs, and then again, we are in a scenario where inflation should not run away. This is very intuitive. And really, the technology is going to evolve even further with what is called quantum computing. These are computers who are going to go much faster than the current ones, but these computers, the applications of these computers will be directed towards basically manufacturing. So who knows, how the world is going to look like in 10 years. So, the technology, it is what it is, but I think we should be aware that it has a profound effect on macroeconomy and also the microeconomy, because corporates can't really price their goods the way they did in the past or the way they wish to do so to maintain very healthy margins. So, one of the end results of relatively range-bound and stable wages is that inflation stays relatively well-behaved, even in the US. This is the average hourly earnings index, which represents about 80% of non-farm payroll in the US. And as you can see, from 14 to today, it's relatively stable, more or less. And it's interesting, the expansion in the US really started in 2014, 2015, after the oil shock, and one would have thought that perhaps we would have experienced more wage growth then, but we didn't. So, CapEx, capital expenditures. We spoke about weaker pricing and the fact that corporates don't invest as much, and not as much as they used to in the past. These bars show you the level of cash that is available to corporates throughout the world. The cash is there. They have a lot of cash, especially in the tech sector, but it's not being invested. And it's not being invested because, they haven't got the pricing power that they used to have. Yeah? In 2017, we saw CapEx going up a little bit, so more investments, but this is represented on a global basis by the energy sector. The energy sector went through a crisis in late 14, 15, and beginning of 15, So they invested less, but now they're picking up a little bit the investments because oil prices have gone back a little bit higher. But we're still way below the 2013-2014 level. So, if CapEx jumps here and there is a lot of hiring and, much greater, wage growth, then we might worry a little bit about inflation. But it's not the case. And it might increase a little bit this year, but it's unlikely to go back to the 2013 level. So again, another argument as to why inflation should stay relatively well behaved. So even in the US, and I'm speaking about core inflation, ex-housing or ex-shelter is relatively low. Okay? We saw a little bit CPI jumping in the US at the end of last year, but remember it was because of the hurricanes. There are seasonal effects. Auto prices went up a little bit in the US. That tended to drive CPI a little bit up. With the hurricanes, people needed to replace their cars. So the price of used cars went up quite a bit. But I don't think this is anything to worry about. So inflation, as the second key takeaway of our investment case, is to remain benign because of the technology and because basically corporates have lost their pricing power. The 10-year yield is very important when we think of investing in bonds. And each year, it's always the same story. We come in, people tell us, oh, inflation is going to run away. Benchmark yields and government bond yields will jump quite a lot. We heard that last year. It didn't. Who knew last year that we started the 10-year Treasury at 2.45 and we finished at 2.4? So this is a beautiful environment to invest in spread products, either corporate bonds or emerging bonds. And again, this year, we expect the 10-year to be within a range. And actually, maybe 240 to 265, 270. Today, the 10-year Treasury represents very decent value at 270. So actually, investing, in income solutions like the ones we're going to present to you makes really good sense, especially at a time where income is relatively scarce. If you buy into the argument that interest rates are going to stay relatively low, okay, it takes much longer for people to save and to achieve a decent savings pool to live on when they retire. So actually, there is an incentive for people to save more today because it takes longer to get to what they want to save. Okay? So again, if people save more, they spend less. And then we're in another loop which is difficult to break out. And in the end, it points to monetary policies to stay relatively accommodative to help the economy. So the 10-year could stay within a range again this year, which is basically what we predict. Inflation is not going to run away because the pricing power is no longer there. And then we could be in an environment which is very conducive and very attractive for the solutions we're presenting to you. Now I'm going to show you some slides to alleviate a little bit the fears that we may have heard in the markets in general, okay? Because we could eventually be a little bit worried about what's going on with the central banks. For example, the Fed, they stopped buying bonds. This is not completely true. They are not going to reinvest what matures up to a certain extent. So I think this slide is very interesting in the sense that it shows you what is going to mature within the Federal Reserve balance sheet this year. So they have about 420 billion of treasuries maturing, and they're not going to reinvest about 210, 220 billion, the caps that they have instituted and that you have heard about. But they are going to reinvest anything that's above. So they're going to reinvest about 210, 220 billion. And the interesting thing is that the Fed did not tell us at which maturity they're going to reinvest, right? Will they reinvest at 5-year, at 30-year, at 10-year? We don't know. So the Fed still has the ability to manipulate the yield curve the way they want to suit basically the US economy, because they have the power to do so because they're going to reinvest. but they have not told anyone, at which maturity point they are going to reinvest. And it's interesting to also notice that the Fed, they have the dot plot, and that the long-run dot plot is stuck at 275 at the long end. Okay? So maybe they want the long end bond to be around 275. So they will make sure that it stays there to match the dot plot. It makes sense. Another interesting story, the Fed is not going to reinvest about 220 billion more or less this year. But there are other buyers as well. Okay? Which could be those other buyers in the US? Well, with the fiscal plan that Mr. Trump has delivered to the corporates are going to have more cash, right? But the corporates have a lot of unfunded pension pools. Their pension funds are unfunded. There's a huge gap. So they could use part of the tax savings that they get from Mr. Trump and reinvest that in their pension funds to make sure that they become better funded. Okay? And it's been estimated that the pension funds could buy easily 100 billion of treasuries this year to improve their funding. So although the Federal Reserve reinvests less, you have other buys that come in to make up for the gap. So that's quite interesting in my view. Another potential buyer, and which people maybe brokers tend to scare us a little bit with their messages. Oh, they told us, the Federal Reserve balance sheet is going to decrease a lot and it might go back to 1 trillion, where it was, in 2006, 2007. That is mechanically impossible. Let me explain why. Because the banking system in the US, like any banking system, gathers new deposits all the time. So there is economic activity, company A, B has more profits, more cash, puts it at the bank. The deposits within the US bank go up. On average, they go up 450 billion a year, more or less. Okay, it's a big banking system. The banks have to keep, it's law, some of those deposits are as liquid instruments. That's the liquidity requirements, okay? So it's estimated this year that out of 450 billion of deposits, or last year as well, a good 20 to 25% has to be invested in treasuries, right, to be able to meet the new liquidity requirements that the bank have all the time because their deposit base goes up. So the banks, either they buy the treasuries and they give it to the Fed, or they give cash to the Fed and the Fed buys the treasuries for them. So again, it's estimated at 120, 150 billion this year. So this is an additional buyer to the market. But the banking system in the US continually builds up its deposit base. So mechanically, the Federal Reserve balance sheet might come down because they reinvest less, but throughout the years, it's going to go up again because the deposit base in the banking system keeps on going up, and then they have to meet the liquidity requirements, and then the Fed's balance sheet, has to continually to go up because they hold the securities on behalf of the banks. So that's quite interesting. So don't worry about the Fed balance sheet crashing and really creating a problem for the treasury market in the US. It's not going to happen. Another interesting thing is that when you look at the US economy, when you look at commercial and industrial loans, okay, banks make commercial and industrial loans to corporates. This has not grown at all for the last 3 years. There is simply no borrowing at the corporate level in America. You can pull this out of Bloomberg, it's very easy. So you have a banking system that accumulates deposits all the time, and there is a lack of demand for loans. So what do the banks do? They buy perhaps more treasuries. So really, we shouldn't worry too much about less reinvestments and even the end of QE in the European area. That leads me to that slide, which is quite interesting. QE is one thing at the ECB. Reinvestments is another thing. Okay? It's very important to differentiate between the two. Let's imagine that the ECB stop their QE program in September. Their reinvestments of maturing bonds this year alone is 180 billion euros. That's quite a lot. And next year it will be the same. So the ECB will continue to reinvest their maturities, they said, and Mr. Draghi said, until he reaches really his inflation target. But really there are doubts as to if he's going to reach his inflation targets in the future because of the pricing issues we have highlighted early on in my speech. Another interesting thing, now I know people tend to be pessimistic, but me, when the sky is blue, I try to find arguments to make sure that the sky stays blue. Okay? There could be very interesting developments in the European area, especially if Mrs. Merkel is able to form a coalition with Mr. Schulz. So Mr. Schulz, Mrs. Merkel, and President Macron, they want more Europe, not less Europe. Even from a geopolitical standpoint, it makes a lot of sense. With what's going on in America, America is really it's not orderly America. It's become a little bit of a, if I may say, excuse the term, it's a banana republic, it seems, with Mr. Trump. Now, there is a need for a strong Europe, considering what's going on in the US and also in Asia and Russia. Okay. So if we are lucky enough, and I tend to be optimistic, that we get more Europe, that we get Mr. Schulz in, maybe Mr. Schulz will look after the finance ministry in Berlin, then he works with Mr. Macron to implement this more Europe, right? So we could be, if we are more Europe, you remember the conversion trade in 2003, 2004? All the Eastern European bonds converged towards, that of Germany and the rest of European bonds. Well, we could have the same again. If we have more Europe, the periphery might start converging towards basically the Bund. Why not? And that would be a gift to Mr. Draghi, because in the end, if we have more Europe and then, periphery bonds converge towards, French bonds or something like that, it's a beautiful exit point for Mr. Draghi, because then QE becomes irrelevant. Okay? If there is more Europe, there will be conversion, he could stop, and in any case, spreads will continue to tighten. Beautiful exit point for Mario Draghi, who is a remarkable man, by the way. And I hope that if that happens, he becomes the European finance chief, because Mr. Macron wants to create a European finance ministry. So out of the ECB into the finance ministry in Brussels. That would be perfect. So I've painted to you what we think, for what it's worth. Remember the key takeaways: the corporates have lost their pricing power. Because of that, inflation should stay well behaved, and government bond yields should stay within a range. That's a very good environment to achieve spread carry income, and global spread products are quite attractive as a result. By global spread products, I mean corporate bonds in developed market, but also emerging bonds in emerging markets. This is still attractive, and we'll show you why. Perhaps a parenthesis. People might also say, well, we've heard that, for the American brokers, that we're at the end of the cycle. We've been at the end of the cycle in the US for 4 years now. It hasn't happened. What I want to show you is that an expansion never dies of old age. That's a fact. Okay, you might have, an expansionary period for some time, then you muddle through, then there is a bit of volatility, but the expansion is not killed. What kills an expansion is basically an external shock. And we've highlighted some examples for you. It's very simple. In the 1990s in the US, when you have an expansion, usually it comes with a build-up in leverage, right? So when you have a lot of leverage, then it becomes a little bit problematic. Then in the 1990s, we had leverage, some of you might remember, with the savings and loan banks in the US. And in the 1990s, we also had the problem with real estate in Sweden and Finland. You remember that the Swedish banking system and the Finnish banking system collapsed in the 1990s. Okay? But that wasn't too much of the problem. What was the problem in 1990 was basically the Gulf War. The Gulf War came and it killed investor confidence and CEO confidence. Less investments, and then we went through a major downturn. It was the same, in year 2000 with the dot-com bubble. Came 9/11, the terrible attack on the US, then confidence was gone. Okay, it's a confidence game. Finally, that brings us to 2008 and the subprime crisis in the US. What really did it for the subprime crisis was the leverage at Lehman and the decision of the Fed not to rescue Lehman. That's external. Okay? So in the end, an expansion does not die of old age. Today, we have an expansion. We haven't got a lot of leverage in the banking system. The European banking system has been basically repaired. Okay? It's in very good health. We haven't got leverage at the industrial corporate level. The leverage there is relatively low. We have leverage at the central bank level in Europe. But that's not a problem because they can always refinance themselves. We have leverage also in China, okay? But in China, nothing is going to happen because China wants to become more prominent in the world stage. So they will manage it. So China is not a problem. So again, today, this is to point to you that really the investment environment is quite conducive and attractive because expansions do not die of old age, and we have a decent expansion. But the expansion we have is a little bit fragile, okay? Usually when I think of expansion, I'd like to think of it in the terms of, global industrial production growth, okay? Global industrial production growth. Trend growth for industrial production is about 3%, okay? That's the long trend. We just came back to 3%, okay? And it's taken us 10 years to go back to 3%. We're a little bit above 3%. It would be foolish of the central banks to become too restrictive at just this point because it could tip the industrial production growth the other way. And they're not going to do that, okay? So we have expansion. People say, oh, it's fantastic, the growth, blah, 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 blah. But no, it's a little bit fragile because it's taken 10 years to go back to trend growth, okay? Remember that. So with that, in a world where we believe that rates and government bond yields are going to stay relatively low, we need to achieve income. And I'm going to show you some examples of basically income and what we call in developed market corporates coupon income. You get your coupon. Your coupon is everything, okay? Your coupon is going to give you your return at the end of the year. You just have to be patient. Because if you invest, in European corporates, you don't get any return from price appreciation. You get the return, with the delta, which is basically your coupon income, and then you achieve your total return. So as you can see, price appreciation for European investment-grade corporate is very small. Most of the returns in the past came from coupons. This is a very long-term chart. Of course, today, coupon is going to be a little bit lower because, the yield environment has changed. But the concept is the same. And an important message, when you invest in corporate bonds or emerging markets, it doesn't really matter when you invest. You have to be a long-term investor. Because even if you invested, during the 2008 crisis, if you stayed invested, you would have more than made up. Of course, you would have suffered a little bit 1 year, but you would have recouped everything because it comes back in any case. So as an advice we give our potential clients, when you invest in corporate bonds and in emerging market bonds, you have to be invested for the long term. It's the same picture for global corporate bonds. We have a global corporate bond fund at Vontobel, and really most of the income comes from the coupon. So in a world where income is scarce, really the coupon experience and the income experience that you get from the coupon is paramount, is very relevant. Finally, for high yield, it's the same picture. High yield actually gives you negative price appreciation because of the default rates. You experience defaults, but there is nothing to worry about the defaults because not everything defaults at one time. And the defaults are more than made up by the large coupons that you get in high yield. So really, the income experience is quite attractive. And really, if there is a word of encouragement, is that when you invest in these type of products, you have to be invested for the long term. Now, spread levels today. I just want to highlight where we are and why we believe it's still attractive. Of course, spreads have tightened quite a bit. It's not the high levels that we used to have, but you still get a little bit of carry income today. And carry income, is not negligible. So what we want to show you is that this x-axis is very important to bear in mind. It's the last bull market in credit, okay? So from 2002 to 2005, it was a bull market in credit. Spreads were relatively tight, but they kept on tightening. And the tighter bonds were around 50 basis points, okay? OAS, option adjusted spread. Today, in our European corporate bond fund, we still achieve above 100 of spread, the black line. So you still have quite a good cushion. We're not saying that the market necessarily will tighten to the old levels, but what we're saying, you still have a good cushion, and basically you still have a good spread to enjoy a little bit of carry, okay? And if you believe that the environment is going to stay benign, it's still worth to buy European corporate bonds because, in a fund like ours, we achieve almost 120 basis points of spread. Global corporates are better. Okay, we also have a global corporate bond fund. It's the same concept. The x-axis shows you the last really bull market in global corporate spreads, and then the purple line shows you where it went during that time period from 2002 to 2005. So the lowest point for spreads, during that bull market was 60 basis points. Today, the black line, our fund, our global corporate fund, has about 140 basis points of spread. Quite attractive still, quite a good cushion. So it's not negligible to achieve a little bit of income through carry strategies with such type of products. Finally, high yield. One would argue that high yield is perhaps the market that is a little bit, let's say, most expensive, because the spreads today have reached the level of the last bull market. That's fair. But at 320 basis points of spreads in high yield, we think it's quite attractive. Why? Because the default rates are forecast to be 3% in 2018. The default rates were 3.3% in 2017. And the spreads in high yield are highly correlated with the default rate. So if we expect default rates to continue to go down, high yield spreads, let's say, the best case, they tighten a little bit, but the best case, they stay where they are, and you achieve basically, carry income of 320 basis points, which is not bad at all, also in that segment of the market. So, all in all, yes, of course, spreads are not at the levels we used to have, but they're still quite attractive in our view, especially that we have a benign environment again for 2018 for the reasons we have explained. One very interesting slide, if I may. Barclays Bank has continually run regressions on bonds that the ECB can buy, corporate bonds that they can buy, and the corporate bonds they don't buy. So they run regressions across sectors on a continual basis. And the finding was that the ECB premium for buying corporate bonds is just 10 basis points on average. This is very interesting because it means that at the end of the day, if the ECB stops buying corporate bonds, theoretically, the bonds could just widen 10 basis points, which is not a lot. Maybe they widen a little bit more, but they would come back because The fundamentals are good, and the expansion is ongoing. So really, we shouldn't really be worried that the ECB is in the market and distorting the market, especially if we believe that regression and that the difference between the bonds they buy and the bonds they don't buy in corporates, the difference is just 10 basis points between the two type of bonds. Finally, in terms of sentiment, sentiment is still quite good in the market. We showed you the high yield spreads. This is basically the high yield spreads and basically the default rate. There's a good correlation, and basically the fact that we expect defaults to continue to go down in high yield means that high yield spreads should stay where they are or tighten a little bit. Right, so we've highlighted the themes. We showed you a little bit, where we are in terms of valuations. The themes being inflation stays benign, the corporates have lost their pricing power, they're price takers because of the new technologies. This is a revolution. A revolution does not stop just after 1 year, and really inflation is not going to come back and make big, headline news just because we have 1 or 2 years of good economic growth. These changes are structural, fundamentals, and we haven't spoken also about the demography as well. The demographics are really a structural change which affects inflation, but we'll leave that perhaps to another day. So within that, we still think that it's time to invest in corporate credit in developed market and in emerging bonds. At Vontobel, myself, I manage the Euro Corporate Bond Fund since 2010. I've joined Vontobel in 2010. We were lucky and fortunate, and we thank you for your support, to gain quite a lot of Italian clients. We have been diligent with what we do. We have provided you with good returns. But most of all, we have invested again in our business. This is our credit team at Vontobel. We're now 8 people. And we also have a global corporate bond mid-yield fund, and we invested in the global segment of the business. And we're proud to say that we have now a New York office to help us with global and US corporate bonds. So, partly thanks to our clients which have supported us, we were able to reinvest in the business. So this is the credit team, and it's organized by sectors. So we are stock selectors, we're stock pickers. Basically, the philosophy for us is make sure that when we buy a corporate bond, we get paid for the credit risk that we are taking. That's a very simple philosophy, and that's what we do day in, day out. The fund, we continue to like the market. We have a barbell strategy. We like the subordinated issues. They have performed very well, especially in financial institutions in Europe. We remain overweight in financial institutions in Europe with AT1s and Tier 2s. So, from the one end, we take a little bit of risk, higher beta type of risk, but on the other end, we buy conservative bonds as well. So it's a good mix, for the current environment. With that, we're able to achieve a yield of about 2%. We're going to try to return that this year, perhaps a little bit higher. It's the beginning of the year. Last year, we did about 4%. The duration is about 5, and the average coupon is about 3.6. The duration I'm not really worried about. It's the duration of the index. And as I said, I expect government benchmark yields to drive sideways, so that should not be too much of a problem. Perhaps a quick table. At Vontobel and within the credit team, each of us follow a sector, and we analyze industries. And we do that on a regular basis. And as we begin the year, the sectors that we like a lot is basically European banks. We like that. At the senior level, because we have this new type of bonds, which are senior non-preferreds, let's say, and Italy is also adopting that. We like that because it pays a little bit. We like the subordinated banks, of course. We like the subordinated insurers. In insurance companies do not issue senior bonds because they get quite a lot of premiums. They don't need to issue senior bonds. They issue quite a bit at the subordinated level. That's good value still. We like that. We like the energy sector. So we're basically attractive in energy. We like financial services, and we like electronics as well. So that's a little bit the sectors that are in vogue within the portfolio at this stage. And finally, this slide, which I find interesting, the fundamentals are good. The expansion is not going to die of old age, but most of all, what's very important in Europe is that the banking system is now in very good health, okay? Even Italian banks have made a lot of progress. I know some of you might have been a little bit skeptical in the past, but actually you have achieved quite a lot of progress. And in the fund, we had quite a lot of investments in UniCredit Tier 1s, in ISPIM Tier 1s, in Mediobanca. So we liked the space, we believed in it, and then it turned around. So that was beautiful for us. What I want to show you here is, this is in basis point. This is the cushion that the banks have before they stop paying coupons. So let's take an example. For Unicredito and Intesa Sanpaolo, the cushion is about 500 basis points. To put that in context, you have to relate that to the risk-weighted assets of the banks. So on average, Unicredito and Intesa, they have about 300 billion of risk-weighted assets. Unicredit, a little bit more, okay? So 5% of 300 billion, or 500 basis points of 300 billion, is 15 billion. So before these banks stop paying the coupons, they would have to post a loss of 15 billion. This is inconceivable in this market. I believe Unicredito wants to make 3 to 4 billion this year, as well as Intesa Sanpaolo. So we're very, very far away, from this point where the banks in Europe will stop paying dividends on their AT1s. And it's across Europe. Good cushions. So the systemic risk in European banking has disappeared. The credit quality has improved. The credit quality for corporates also has improved. The fundamentals for the corporate bond world is quite good. So even if the ECB stops buying corporate bonds, maybe we have a little bit of widening, as Barclays showed us, maybe 10 basis points, but I think it would be quite temporary. So that was basically for the European bond fund that I managed, the corporate bond fund. Been managing it for the last 10 years. We've had good results. As I understood that, my Italian is really poor, but I understand it because I grew up in Tunisia. When I was little, I used to watch Italian TV all the time. So I understand Italian, but I can't speak it, which is a shame. I would like to do so. But, we helped you bring home good returns, and we're here to do that for you, and we'll continue to do that. And now I will pass the word to my colleague, Christian Hantel, who will tell you basically the story about global corporate bonds. Thank you very much for your attention.
Buongiorno and good morning from my side as well. I'm glad you're here. I don't have a fancy movie to start with, but I thought I'd bring an interesting slide at least. So I have this one, and I wanted to guess you what it is about. And it's not about Bitcoin, that I can promise to you. It's actually showing the growth rate of the global corporate bond peer group. And that's something which is quite impressive, because you see, right after the financial crisis, this was exploding. And one explanation for that is that people wanted to diversify their asset base. They want to globalize their portfolios after the financial crisis. So this is why we have this impressive growth rate, and I believe it's worth taking a look at it, and I will explain you in the next few minutes what are the arguments for that product or for that asset class. If you deal with that asset class, you have a few unique characteristics. And one of them is it's the broad diversification. We talk about 6 currencies, more than 60 countries, 2,000 issuers, and more than 13,000 bonds. So that's really a very broad and also very liquid universe. And you get something for free which you might not get in another asset class. And that's two important things. One is diversification, because diversification enables you to create a robust portfolio, and I will explain you later why that matters so much. And the second part is relative value. For example, currency mispricings. And I will show you also in detail what that means. So you have a much larger investment set, an opportunity set, than just focusing on a US dollar corporate portfolio or a euro corporate portfolio. And last but not least, credit in general is a low volatility asset class. So usually the asset class generates a solid positive return unless we have a recession. Like in 2008, after the financial crisis, of course, also credit went into negative territory. But apart from that, in normal circumstances, these days, for example, credit is able to generate a solid return without big volatility. So what we offer and what we try to benefit from that asset class is creating a product that takes advantage of that. And we created a fund that is an investment grade fund. So we try to have really the average rating in the triple B space with a decent yield, 3.4% at the moment. I think it went up a bit to 3.5 or so in the last few days. But we also try to be focused. So you've seen that we have 2,000 issuers in the reference index, but we try to be consistent and focused on around 120 plus minus 10 to be really focused and to invest only in the ideas that generate the best returns. And that we do in the US, in Europe, and also in emerging market hard currencies. Something that holds true for Monder's fund and also my fund is our conviction in trend anticipation, in credit selection, and the focus on value. That is something that works for our entire credit products. And last but not least, I mean, we can show you a decent track record. I manage global corporate funds since more than 5 years, and this actually helps when you construct a portfolio. So let's have a bit more deep dive into what I actually mean by diversification, why it matters so much. You see, this is the universe I can invest in. It's really a very broad range from the US, Europe, and emerging market. And this diversification really pays off. And we brought you one example that is most recently from the Brexit. And we looked at the spread widening when Brexit actually happened. And you can see that if you would have a pure UK portfolio, your spread widening was quite prominent. It was less so in a Euro portfolio, or European portfolio, but much less in a global portfolio. So really, diversification pays off and makes your portfolio more robust. The second point I mentioned, that's relative value. And this is something interesting to know. Multinational companies, they issue bonds across all currencies. And by being in a global portfolio, you can actually benefit from that. Because you will see in this example, Daimler, the automotive manufacturer, with a euro bond and one in dollars. So the black line is the dollar bond, and the blue line is the euro bond. And you have the yield of those two bonds. And it's all hedged back into US dollar. So the euro bond is hedged back into US dollar. So I don't want to have foreign currency risk. I want to hedge my currency risk. But I can show you that sometimes the lines are more moving simultaneously, so you can extract extra value. But there are times when the gap opens up, and you can actually extract 100 basis points additional pickup for your portfolio without compromising on risk, because we're talking about Daimler. It's the same issuer, the same duration, so the same rating. It's just because we are different currencies with different characteristics, and you can extract extra value. That's something unique in a global fund you will not get in a pure US dollar portfolio, for example. So how do we manage credit portfolios? I will not go through the entire process here, but I wanted to show you there's a solid process behind. It's proven already with the Euro mid-yield fund, and we have the same for the global one. And I just wanted to focus on two major steps. The global universe is great, but it's also challenging because it's so big. So you need to be sure that you have it under control. And for that, we use a filter tool. The filter actually allows us to narrow down the universe and to make sure that we focus on the most interesting ideas. And we use for that filters. And one of the filters you've seen with Monder's presentation, that's our sector preference. So we put in the sector preference, for example, or we put in like a leverage target that we want to see with companies, or for banks, a capital ratio. And this filter then helps us to really bring down these 2,000 issuers down to a level of companies that we want to dig into more. So the filter is important. And the second is on portfolio construction. Portfolio construction is important for the global universe because it's so big and it offers you the benefit of diversification. So we focus a lot that our allocations are widely diversified from the US, Europe, and emerging market. And that regional balance helps us also to make the portfolio more robust. So what's the result actually of all that? And I brought you some statistics on the portfolio. You can see the yield at the moment is around 3.4%. That's a bit higher than the benchmark. Also the spread, that's 140 basis points more than the benchmark. Duration in line with the benchmark. So we try to really achieve our returns with the right credit decisions. There's no foreign exchange risk in the fund. And also the duration risk is always in line with the benchmark. Number of issuers, you see it's relatively focused, 129. I mean, it varies between 120, 130, or 110 in that range. And the rating is, as I said at the beginning, in a BBB. So the result of that is also since inception an outperformance of the funds, but without compromising on risk. We pay a lot of attention on risk. And this you can see actually when you look at the beta of the fund. Since inception, the beta of the fund is in line with the market. So that's what we try to do, outperform or deliver a solid outperformance without going into excessive risks. And some other ratio, some of you might know, is the upside-downside ratio. Basically, this says, is the manager capable to benefit when the market is bullish, so to outperform in the market when it's bullish, but also not to lose more when the market is in a downturn. And if the ratio is above 1, then this shows you that the fund is actually doing better if the market is good and losing less when the market is a bit more shaky. So this is what we try to achieve. Solid returns, but with a relatively low level of risk. To achieve that, credit selection is key. So selecting really the right credits, and you've seen in our investment process that we do our own fundamental research. So let's spend maybe 2 minutes on credit risk and credit valuation. And I brought you 3 graphs, basically. One is on earnings, one on leverage, and one on rating trends. These are numbers for US companies because they have been in the headline quite a bit for their strong returns, but also for their leverage. So if we kick off with the left-hand side, you can see the expected earnings for this year. Usually the equity investors focusing more on that, but also we from the bond side are keen on looking at that. So the S&P expected growth rate for this year is more than 10%. That's still quite very solid. You have some outliers like energy doing quite well, other sectors doing a bit more poorly, but also a bit more stable. But in general, the environment, as also Monder highlighted, is doing still quite good. So let's have a look at the leverage ratio, because some of the US companies have been in the news that took on too much leverage. And that's actually true. If you have a long-term chart, and you look at the net debt EBITDA ratio, which is a good metrics for leverage, you can see there was a trend of upward leverage since the financial crisis. This is because companies recovered a lot, so they were able to take on a bit more debt. They did M&A, they did share buybacks to please their shareholders. So this is why the leverage ratio went up. And this is where the point when I also get a bit more nervous to see when does it stop actually, because you don't want to have too much leverage as a bondholder, because that would trigger rating downgrades and spread widening, not what we want. We want leverage to stabilize, and this actually happened in the last 2 quarters. In the US firms, leverage went down, mostly because also M&A activities went down. You still have a lot of big M&A activities in the market, but in general, year over year, M&A activities dropped dramatically. And this helped also to bring leverage down in the US. This is something reassuring, so we know leverage is not going through the roof. That's also very important. So last but not least, the rating trend for Europe and the US. And this is a very interesting chart. The ratio above 1 means we have more rating upgrades. If the ratio is below 1, we have downgrades. The most recent trend is strong momentum in Europe, a lot of upgrades, and stable, I would say stable, but still above 1 in the US. So we have a good environment, but this chart shows you also some, gives you information on what happened in the past. If you look at that scenario after the financial crisis, you see ratings really went down, both in Europe and in the US. But then it was a long trend of upgrades in the US after the financial crisis, and not so in Europe. And this is because Europe had to digest the Euro financial crisis, which made the continent suffer a lot from that. So you see the ratings dropped again in Europe, whereas the Americans really went up to a great shape. Now we have more of an aligned development with a strong momentum in Europe, but with a stable or improving rating trend also in the US. So what does it mean for the portfolio? What you will find in the portfolio that we still favor triple Bs over single As. And if you look at Sharpe ratios in a historical time series analysis, you will find out that triple Bs are a better investment than single As when you look at Sharpe ratios. So we still favor them. We also like to add some of the emerging market hard currency bonds. It is good for the diversification of the portfolio, but it also adds a bit of more carry to the entire universe. Where we are very conservative and what we try to avoid is sectors in disruptive positions, such as retail, especially in the US, but also utilities. Here we usually have an underweight. What we still like is banks, but also energy. Energy companies really recovered a lot. They decreased leverage, and you've seen the earnings, the expected earnings growth for energy is among the highest. You've also seen the credit trend is positive, rating trend. So what we try to benefit is from rising stars. So we try to implement companies in the portfolio that are able to move into investment grade territory, and we try to be in there quite quickly to benefit from a spread tightening. So this is also what we like. On a relative value point of view, we still have an overweight position in AT1s. So banks in general we like, banks subordinated. And then when it comes to Europe versus US, the two markets don't offer like an easy choice at the moment. They both are trading at the same level, but then you're benefiting from the global approach because if you focus on an issuer level, like you've seen with the example of Daimler, then you still be able to find value. And this is what we do all day in and day out. So what I would like to remember from that presentation on global corporates is the asset class is quite unique. It offers you some key advantages you will not get in a single currency portfolio. Namely, you will have your investments well diversified, and you can benefit from these relative value opportunities. Last but not least, we remain positive on our outlook, also for 2018. We think it's a great environment for corporates to work in. And we will focus with our investment process on credit selection. That's our core position. So before I stop, a quick word on performance. This chart is very crowded, so maybe we focus a bit on the net returns here. The fund was launched in 2015, and it has proven that our investment process delivers some alpha. You can see in the chart here. And for those of you who want to see a longer track record, I manage global corporate bonds since more than 5 years. That's my track record with Citywire. And, but it's not only me, as Marder said, it's a whole team behind. And I'm also very proud that we have colleagues in New York that especially help us on analyzing the US corporate sector in detail. With these words, I thank you very much for your attention, and I stay around for questions.
So, good morning, everybody. Also, from my side, a very warm welcome. So now we turn to emerging markets, and one important question is, of course, what differentiates credit in developed markets to investing in emerging markets? And I think it's an important question, and we in Vontobel, we think that one important difference is really governance. Governance, what do we mean by governance? It's the institutional framework in the country. It is also the norms and the values and the traditions that guide decisions. It is also what we would call the rules of the game. And we believe that the rules of the game in emerging markets are quite different than in developed markets. It's important to understand that there are many countries in emerging markets, and this means that the governance in different countries can be very different. This does not mean that we cannot try to formalize this, and this is exactly what Moody's did, and this is what you see on this slide, is how Moody's tries to capture the difference in governance in the various countries. And they have a few building blocks in the third column here. One is the rule of law. And this is important, I think, to highlight for many people. When you invest in emerging markets in hard currency, you are actually relying on the rule of law of developed markets. You are investing in external debt, and this means that the law, New York law, usually New York law, or also British law, is applicable for these investments. That does not mean, of course, that governments cannot run away with your money. They can invent rules that allow them to steal your money, so you still have to be careful even if you are under international law. Moody's also includes government effectiveness or policy credibility. This allows governments not to run in trouble in the first place, so it's very important. I think one important aspect of this rule of law is that typically sovereigns, as Luc will show you, they do not default very often, and when they do default, the recovery rate tends to be relatively high. In corporates, it's a bit different. Corporates, they do restructure, I would say. They can default, but usually they try to negotiate with bondholders and not liquidate. So this is also very important. This is another map of the world. It's from the World Bank. It shows you a governance indicator, which is here voice and accountability, is the perception of governance as developed by the World Bank. The World Bank has other indicators. Basically, they have 6. They have also government effectiveness, for example, or control of corruption. What is important, what you see here, is that developed market worlds, they have better governance than emerging market world, and this has, of course, implications. One important aspect is that the World Bank looks at perceptions of governance. And some people criticize the World Bank for looking at perceptions rather than at the facts. But we think that the perceptions are really important because they drive the actions of people. For example, if people don't believe in the courts, they will not rely on the courts to enforce their rights. In the same way, if a business executive feels that the business climate is very poor, he will typically not invest in the country. And also for us, perceptions for investors are very important because it results in a higher remuneration that you ask for investing. Secondly, there's another reason why perceptions are important. Because some people, they like to rely more on the facts. But I think the facts, they often cannot represent what is happening on the ground. It's just the laws, but sometimes people have very different experiences. And therefore, for us in emerging markets, it's very important to meet with companies, to meet with country policymakers, and basically to look them into the eye, to understand what is happening. So what are the implications for us investors? The implication is that the remuneration that investors ask to be compensated for this poorer governance is a higher spread. So the remuneration tends to be a little bit higher in emerging markets than in developed markets. We use basically in Vontobel 2 definitions. One is the narrow financial definition, which relies on, again, the rule of the law. The definition is corporate governance deals with the way suppliers of finance ensure themselves to get a getting a return commensurate with the risk they take on their investment. So you make sure that you get rewarded for the risk you are taking. But there is also a broader definition, which is also quite important in our view. It is that corporate governance is concerned with ensuring that firms are run in such a way that society's resources are used efficiently. That can sound very abstract, but it's very important because it points to the rules of the game again. And in developed world, a lot of attention goes to shareholder value, to value creation. In emerging markets, sometimes it's a bit different. Sometimes you have development banks, they are involved in developing the country. They are not driven by profit maximization. Or you have sovereign-owned entities that are important for taxes in the company, in the country. And so these create different incentives for companies that operate in emerging markets, and this leads to a different way of looking at investing into emerging markets. As I said, spreads in emerging markets tend to be higher. The question is, how much higher are they? And are they high enough to compensate you for the risk? And so what you see here on this chart is two bonds from Telefónica. The blue line here at the bottom is Telefónica in Spain with a maturity of 2022. The black line is Telefónica Colombia, also with a maturity of 2022. Telefónica Colombia is owned 70% by Telefónica Spain and 30% owned by the Colombian government, and it's the largest mobile operator in Colombia, so it's an important company. Still, what you see, the difference, the blue shaded area, is the difference in spread, and this is about 300 basis points, I estimate, on average over this period. You see that the spread is higher, but also that the volatility of the spreads is much higher. You see, in the beginning, at the end of 2015, beginning of 2016, spreads are relatively high. Here they increase quite a lot because also Telefónica Spain increases quite a bit because there is general low risk appetite at the end of 2015. But in 2016, mid of 2016, you see a big spike in spreads in Telefónica Colombia, which make you lose about 7% of the value of the bond, whereas in Spain, basically nothing happens. So there are different events happening to Telefónica Colombia that affect the bond prices and can make you suffer on your portfolio. This is important, and so the question is now, are you remunerated enough? I think to answer that question, there are two ways to do that. First of all, it depends on, obviously, your personal risk appetite, but it also depends if you have a manager that can identify good risks from bad risks. And we in the corporate fund, we specifically embrace this volatility. We consider this volatility a fact of life, just like sun is a fact of life in Italy. And I will come back to this example of Telefónica Colombia and illustrate to you how we benefited from this volatility in the market. But before this, I will give the word to Luc, who will talk about the outlook in emerging markets in general.
Thank you. Thank you for being here. Thank you, Wouter. Very interesting. Today, I will mainly highlight the important things in EM and answer the question, after this quite impressive rally that we have had, returns the last 2 years were really very, very good. Does it still make sense to invest in EM? And the answer is yes. Am I excited? No, I'm no longer excited as I used to be. That's gone. But do I still like it? Yes, of course. Spread is really paying you much more than you need to have to compensate for what Wouter said, what sometimes happens, but not too often, that are defaults. There are sometimes defaults, not too often And most of the time, you don't lose much money with defaults. So let's have a look. There are different things that make me think that EM is still attractive. Behavior of investors. And behaviors of investors, they follow a few things. They follow a little bit market capitalization. It's not too important, but they do it. And they follow news. News is also not always so important, but they do follow it. So we have to take that into account. If you look here, on the left side, you can see the EM contribution to world growth in red. And what you have versus the developed world in blue. So EM growth is really important in the world. That means also, due to that the asset class is probably growing. And you can see on the right, for instance, the spectacular growth of EM corporates. Now we're looking to just corporates, and we look to the real corporates and also quasi-sovereign issuers. Over that period, you saw an increase of, it's just 6 years, and you see an increase of 260%. So that's really growing very quickly. And what does it mean? That for investors like us, here in Western countries, EM was something exotic, something really risky, and most of the people didn't look too much into it. Well, Italians did to some, and happily, I'm very happy and very thankful that you were the first to move in and you are our most important clients. But many other investors in the developed world, they're a bit scary about it. But because it grows so much, more and more people start to look into it. And when they really look into it and they see how attractive it is, they cannot walk around it, or it's becoming very difficult to defend. So you see continuously investors of pension funds, for instance. They didn't look into it. Now they look into it, they add it into the benchmark, and they're hugely underweight. So you have a continuous flow into this asset class, which is important to sustain it in the future. The other thing I said, news. Not too important, but it drives investors. And EM, we had the financial crisis, 2008. And then EM was great because just after the financial crisis, the growth was really coming from out of EM. But they did expand credit at that moment a little bit, and it did become a little bit more tougher. And after that, we have had like 5-6 years disappointing numbers out of EM. Continuously a bashing on EM from, yeah, we have to review growth to the downside. It's not going to give what we did expect. But next year it's going to be better, and next year again, we had to review it on the downside. Time and time again. And I think when you hear that, when you look to the media, I think most people were almost thinking that EM growth was much lower than developed world growth. No, it never has been. You see EM growth on the top here in blue, and developed market growth below there. It was always higher, but the difference between the two growths has been decreasing for about 5 years. Since the mid of 2016, this is changing. Economists don't review EM growth downwards anymore. They generally review it upwards. That's really a change of mind. And you see also that the growth, which is good everywhere, also in the developed world, IMF did review yesterday. It was the biggest positive review since the financial crisis. So change in expectations. You see it growing, but the difference with the developed world is increasing. And that drives investors. That's what they hear, so they think it's going very good. And you see more and more investors coming back to this asset class, and that was driving the real flows that we have seen last year. There may also be some reasons why people don't invest in EM. Many people are a bit worried about rates. Now, I'm slightly less positive as Monder, I think, about rates, but I'm positive about rates. I'm not that negative. I think rates will go up a little bit. Does it mean that you lose money? No, you have to compare to the forwards. Will it rise quicker than the forward? I don't think so. At this level where we are right now, I don't think so anymore. But people are thinking about it. And when when central banks remove liquidity, like the Fed, for instance, Sometimes that was very hard, that did hurt EM, but you have to look in the past, did it really hurt EM most of the time? Look to the last hiking cycles that we did have. You see in 2004, where in fact the Fed did raise rates quite aggressively, and people were very nervous about it, and the spread on EM did increase just before they started hiking, and since then it only went down. And the same happened in 1999. Spreads came down when the Fed was tightening the policy. The time before, you cannot extract it anymore of Bloomberg. That's why we don't have it. The time before was the Asian crisis, and then it did hurt. Then EM did correct a lot when you had a tightening cycle. So this is not a guarantee for always having good returns when the Fed tightens. No, not at all. But it's definitely not a guarantee to have bad periods. Then people overlook into it and are overly afraid of it. And it's to some extent it's logic. Because if I talk about hard currency debt, it's generally dollar debt, and of course it's in dollars. When Fed increases rates, probably treasuries goes up, so you get a better alternative. We are paid in a spread versus that, so our rate should increase also. But no, really in this period, EM, not just the spread did decrease, even EM yield did decrease. And you have to see why do they increase rates? Well, they do increase rates because growth is good. And good growth in the US is also good for EM normally. So that helps. You have to wait it a little bit. So it's unpredictable. Don't be too afraid of the hiking cycle. The last hiking cycle, people were nervous before. They were nervous in 2013 with the tapering discussion. But we see spreads coming down. So where are we now? If you look in this asset class, what yield can you expect? I think, and we compare here EM corporate, of which Wouter will tell you more, and EM sovereigns. Now what you can see is EM hard currency sovereigns, you still get a quite nice yield of almost 5% there, and a spread which is now slightly less, 270. When you look to the MB Global Diversified Index, you can also look to the MB Global, the second most index, where it's rather 3%. I think that's attractive. That's fine. If you compare to corporates, you tend to have a slightly better rating of that index. Different mix of countries, only the bigger countries who enter into the index, and they have thus a better quality. At the same time, you have a much smaller duration, and for some people this tends to be important these times. So I think that's also a really nice asset class. Actually, it looks better. When you look to past performers, because that's also driving investors to some extent, for years we had a very nice performance. This is over 15 years. This is like equities, or even better than equities, slightly better than US equities. But with a big difference with US equities, much lower volatility. And you get similar things on the corporate side. Volatility and return roughly the same. That's quite attractive. Valuation, where are we now? Is it still worth to invest in it? Yes, in EM, you have seen in the long time ago much wider yields than we do have right now. And the same with spreads on this side. No, contrary to other asset class, EM is not defined by its quality. So that's a different, something quite important that's different. At the beginning in '93, when these asset classes were created, it was 98% high yield and and just 2% investment grade. So you have seen a big improvement, not continuously. We've seen that it at one point was almost 60% investment grade, and now it's 50-50. So it's a small deterioration lately. But if you look post-financial crisis, our yield is roughly the same as over the average over that period, and the spread slightly also quite the same. Slightly tighter right now, that's true. We have seen years that it was tight, but I think this is sufficient. A spread of 270 is nice. When you compare EM again to the corporate side, what you can see is For instance, Brazil is one example. You have the sovereign in green, the curve. When you looked into the quasi-sovereign, we took a big overweight in quasi-sovereigns because we think there's quite some value there. Petrobras, in this case, you get like 130 basis points more remuneration. And when you go into Brazil, in the corporate side, you get even much more paid, just for a slight reduction in credit quality. So that makes absolutely sense to look into the corporate space in EM. So we have a spread, 270, and sometimes you lose some money into EM. So therefore, we look into the research of Cruces and Trebes of 2013, and they did analyze till 2011 sovereign defaults. And what you can see, there haven't been that many. So this is just about bonded debt. So before you had the Brady period, etc., when in the 80s there were quite some defaults that were on loans. On bonded debt, we didn't see many defaults. Like on average, it's just one a year. And in the world, there are more than 190 countries. Some discussion how many exactly, because not everyone recognizes the same countries. So one country a year is not that much. It's not just EM, it's EM and the developed world that I showed there. And post 2011, we also, this was restructurings, which is easy to define. Post that, we also looked into what we have seen in defaults and restructuring since 2011. And we put them here. There's those who are in the benchmark we only put. We also had Republic of Congo at some point, but they were not in the benchmark. Now these countries, when you see the index weight on the 7 years, if you add them up, you come to about 7% that has been defaulted. Several times, but we counted them several times. We looked into the index weight that they had at the beginning of the year of the default, so it's not that much that defaults. And Cruces and Trebes said, the average haircuts are only 37%. That means you recover most of your investment when you have a default. It's not a drama. And I think recovery rates, they have very wide space. Sometimes haircut is 2% and sometimes it's 95%. So it's a very wide space and it's not very predictable. But I believe they're going to decrease in the future. Or they did decrease in the recent history. And the main thing is the way Argentina has been treated. Argentina was not very willing under Peronism, under the Kirchners, to deal with the defaults. And they have been punished very severely with it. So since then, we have seen, for instance, Ukraine restructuring. And I must say, I was really surprised by the recovery rate. They paid back like a very big amount, despite the huge and very complicated situation they were in. So sovereigns understand now it's extremely expensive not to deal fairly with bond investors. And when we look to the performance that those countries that did default had in the year of default, you can see like 15% for Ivory Coast, while the index only performed 7%. In fact, of all the countries in the index, it was the sixth best performer out of 41 countries. Belize was a bad performer, very bad. Was not really expected and it performed very bad. Argentina, you know, it was a technical default and were really made impossible to pay investors, but they were very willing to pay, and in fact it performed very well. Ukraine, in the year of default, 42% performance. The best performer of the index, but of course the year before it was a very bad year. I must admit that. Mozambique didn't perform very well, but in fact you didn't use that much money. It was one of the worst performers. That was in the year that they did restructure, and the next year they defaulted again on it, but people didn't care too much. In fact, it was quite good performer in the index. We've seen Belize again performing massively last year. 57%, again the best performer, but following again a very bad year. And Venezuela, in fact, defaulted this year. Performance of Venezuela is still it's only down 34% because you see, in fact, they went down massively, but they paid a lot of interest at the same time. And this is after a year where they were the best performer in the index when they performed 50%, or slightly north of 50%. So on defaults, yes, it can hurt, but it doesn't need to hurt, and you can make a lot of money out of it. The spread that you get largely compensates for this. So this environment with changing news, with more people looking into EM, with really the news that is a positive flow that really drove investments last year. And the inflows in EM hard currency asset class was quite massive last year. That's a dark blue line. Now the line of 2018, it was taken here on the 4th of January. So we didn't see that much inflows of the 4th of January, but we're really starting very good this year again on inflows. And I'm happy with the issuance that we have seen, because with so much demand on EM, I'm happy we had to supply. The supply permitted us not to see spreads tightening too much. Now, maybe you think, what kind of investor is he? He doesn't want to see a tightening of the spreads. But in the long term, you earn more if it doesn't tighten too quickly. And you can reinvest at those rates. So I'm not really willing that. But most people, in a situation like now, or in any other situation, they see the performance that we've seen, and they say, maybe I should time. Let's see, maybe wait for a correction. Now, when the correction will be there will be a lot of negative news. And at that moment, probably we'll see more people going out again, rather than going in. So you need to be very brave to go in. But imagine that you're terrible from a timing point of view. And you did take the decision to invest in EM back in 2007, when the spread was only 162. And you look, what would be my return if I kept it till now? Well, this is the end of October, when the spread was 285. Ooh, that might be horrible. No, it's not. The return on EM is this black line. If you kept that investment, went through the financial crisis, you would be sitting on a return of 110%. If you would have played it more defensive and invest in treasuries, you would not have seen that volatility, but you would only be sitting on 54% return, despite an almost doubling of the spread. So I think that's very surprising. Now you could also choose the yellow line, which is the S&P 500. Gives a slightly better return than EM over that period, but with a much higher volatility. So don't lose your time with timing. It's very complex, very difficult, and you can have good returns without concentrating on that. This is our EM team. Thanks to your money, we could invest and we could expand it a little bit. So we have now a very good quant analyst, Cecile Satie here. And we added on the local port, we added Thierry Larose, a very good track record on local currencies. He joined us earlier this year, 15th of January. He has an ESG approach, so I'm really inviting you to look into his performance. He probably will come quite soon to Italy, I guess, to see and meet you. And we also added, like bit more than 1.5 years ago, Sergei Goncharev, who is a deputy PM on the corporate side and also an analyst. So the team is expanding slowly with quality people, with people who really fit in the team. We don't want to grow very quickly, the team. We like small teams. We can be very agile, and we have to understand everyone. So that's why we expand, in fact, slowly, but with quality people. This is the portfolio of the external debt. I quickly view into it, then we go back to the corporate side. Yield to maturity of my current portfolio at the end of November is much higher than the benchmark, and we achieved that with a similar rating as the benchmark. Yes, at that moment we're slightly lower. Currently we are exactly the same, or even slightly better than the benchmark. Spread is much higher, 390 in our portfolio, thanks to really bottom up and do a careful selection of bonds that we can have. Positioning that we have, these are the classical underweights that you have seen since long. We don't like Philippines, we don't like Hungary, Poland, and Chile. They are too expensive. China, we did invest lately. So this is still an underweight, but no longer 3.3%, it's only 1%. In fact, we did invest quite a bit in green bonds from China that were quite attractive in euros. And then on the positive side, what we like some supranationals. We still like Argentina a lot. We like Tunisia as well. Very relative value in Tunisia is very nice. Euro and yen bonds to pay you 100 or 200 basis points more than on the dollar side. Of course, the yen is a bit longer. That should be compensated also. And we love still Mexico. But we become more defensive, and for instance, the United Arab Emirates position that we do have right now is an indication of that move. Thank you for your interest, but after all I said about corporates, briefly, I would like to invite you to listen more to Wouter, who is managing a fantastic EM corporate fund.
Thank you. So, thank you, Luc. Again, thank you for still being here. So, I will talk about the EM corporates, and the title is Decorrelated Income. And I will explain to you what we mean by decorrelated income. And I'm very happy to introduce what is actually the little brother of the Emerging Market Debt Fund. And why do I say it's actually the little brother? It is because we basically have the same approach as in the Emerging Market Sovereign Fund, but we apply it to a different asset class. So the investment process is exactly the same, but we tilt it a little bit here and there. So what is our investment process, both on the sovereign and on the corporate? It consists of two different parts. The first part is the value-driven inefficiencies. We believe that emerging markets are inefficient, they are segmented. People have constraints, they have regulatory constraints, they have behavioral constraints, and this makes that some bonds of similar risks, they trade at different prices, at different spreads. And if you are an active manager, you can exploit these differences. So on the corporate side, this means that we look across countries, we look across industries, but also within the capital structure to identify the best bonds. We do rich cheap analysis to find mispriced and discounted bonds. This value-driven inefficiencies, they lead to a stable source of recurring alpha that is slowly accruing over time. It is more correlated to the benchmark. It means that if there is a general risk on, these positions should perform in line with the benchmark, slightly better, hopefully. If there is a risk off, these positions should also suffer, hopefully a little bit less than the benchmark. This contrasts with event-driven inefficiencies. I will give you one example, and the example will be this Telefónica Colombia. I explained to you that we embrace these events. We try to exploit them. And what is this event-driven inefficiencies? Sometimes people, they don't really understand what is going on with the company, and this leads to overreaction, to price overreaction to certain news events or to certain corporate actions. Therefore, it's very crucial, again, to look at the governance of the companies to understand the incentives of the different stakeholders to make your decision. So we will look at outsized price reactions, negative or positive. Sometimes there can be positive action of a company, but nobody realizes what is actually happening to this company. And so this creates what we call pure alpha. It has low correlation to the overall market. Why? Because if a company takes a specific action, it will be an action specific to this company. Even if the market sells off and this company takes the right action, you can have a positive performance on this type of position. Or, of course, if you get it wrong, the market may go up and you may go down. So how do we do that? And again, this is the same for sovereign as for corporates. We have a combination of top-down and bottom-up, but we always said that the more crucial aspect is the bottom-up, is identifying the right security within the set of securities that is available. Top-down is more long-term, slow-moving part. We look at the macroeconomic context. We look at strategic themes. These are the globally important factors. It can be interest rate policy, it can be commodity prices, and they will have an impact on different countries, different industries, different countries. But very important, once we have identified here the regions, the sectors that we do like, we try to find the best bonds either in the value trades or in the event-driven trades. And this is really bottom-up. And very crucial also, I think, to highlight is the middle part here that is often forgotten, I think. It is the tradability, diversification, and liquidity. Inherently, emerging markets is a little bit less liquid, so portfolio construction is very crucial. Portfolio construction is actually part of risk management, I would say. And definitely for event-driven, the sizing of your positions is extremely important. Now, this was all the theory. Now, how does it look in practice? I will first give an example of a value trade. This is Pemex. Pemex is a security that is in the sovereign index. In the corporate index, you could have a similar example with Petrobras, the Brazilian state-owned company. So Pemex is the Mexican state-owned company. And what you see is a dollar bond with maturity 2024, a euro bond with maturity 2025. So you have 2 times the same issuer, 2 times the same maturity, so the same credit risk. Both securities, they should give you the same remuneration for the risk you are taking. And this is the spread, is the remuneration for the risk you take. And the spread is effectively the same in 2014 until the middle of 2015. And here you have about 100 basis points difference. So euro pays you 100 basis points more than dollar. That disappears again and then appears again. This has been a very important contributor to the performance last year. Why? You have 100 basis points difference. And this is important because we have a bond of 2025 maturity, so duration 7 to 8. So if this normalizes, if this is mean reverting, 100 basis points tightening with a duration of 7 to 8 generates an outperformance of 7 to 8%. We can get it wrong. It can be that the dollar widens, but the euro should widen less. There can be happening nothing. Then we will generate 100 basis points slowly accumulating through time, or the euro can rally, which actually happened last year, and then we will outperform by about 7 to 8% on that position. So this is very interesting. What is also interesting, and this illustrates why it's important to look bottom-up and not only have the top-down, is to compare with the same issuer. Here you have Pemex 21 in dollar, Pemex 20 in euro. So the same example, same issuer, same currencies, same time period. But what you see is that in this case, at the end of the chart, the euro is actually more expensive than the dollar. So these mispricings really occur on certain parts of the curve, and it is our job to identify these inefficiencies and to exploit them. So this is is a very nice example of segmentation in the market. It creates a broader opportunity set for us and low absolute portfolio risk and trades with a high information ratio. Then we have the event-driven part. Event-driven is really what generates decorrelation in your portfolio and is a bit more important in the corporates than in the sovereign. Why? In the sovereign, there are only so many countries, and not all of them run into specific difficulties. On corporates, there are more opportunities, and we have about, in the corporate fund, 25% in the event-driven part, 75% of the portfolio invested in the value-driven part. So what you see on the chart is 2 bonds, again, of Telefónica Colombia. The difference here, what you see, is the price and not the spread. And what you see, and I know it's a little bit complex, is a senior bond and a perpetual bond of Telefónica Colombia. And what we have highlighted is the red dots, or the green dots, is negative news or positive news. The green arrow shows when we increase a position, and the red arrow shows when we decrease a position. And this is an example how we exploit also differences in capital structure. So important to remind you, Telefónica Colombia, 70% owned by Telefónica Spain, 30% owned by the Colombian government. They have a little bit of problem. They have negative equity under Colombian law, and therefore they need to increase their capital. Then we have August 2016, so this is the first point, negative news. S&P highlights this and says Telefónica Colombia has negative capital and might need to raise capital. Basically, in my view, nothing really happened. It is just S&P saying what everybody is already supposed to know. It happened also this week with Eskom, by the way, where they said Eskom is the South African electricity producer. S&P said Eskom has liquidity problems and the bond's correct. So you see that both the senior bond and the perpetual bond, they correct. The perpetual bond is subordinated, so corrects, of course, much more than the senior bond. Why is that? Because on the perpetual bond, the company is not forced to pay the coupon. If they don't have the liquidity, they can say, we don't pay the coupon because we don't have the money, and that would not be a default. Since we think there is nothing really happening, nothing changes, everybody has analyzed this company and should already know, and they were happy to pay 98, and now you can buy this bond 7% cheaper at about 92. We thought it makes sense for a small position, for about 1%. Then people start to analyze what is actually the news, and they realize it was an overreaction. And you see that the bond prices go up again, both the perpetual and the senior. Here, at the end of September, we reduce our position. Why is that? And this is important because it shows how we are dynamic assessing our position. Because at the end of September, the perpetual bond has to pay a coupon. And you see that people are a bit concerned because the perpetual bond, it rallied, but then it falls back. So people are afraid that still the perpetual bond might not pay the coupon. So we decide, okay, before the coupon payment, we will sell our position. So here we have no position anymore. We made a nice rally. We went from 92 to 98, so we captured the full 7%. Then time continues, and you have the election of Donald Trump. So both bonds correct again because Donald Trump is very negative on Mexico and also on trade and Latin America and this and that. Here we take a position in the perpetual bond. Why is that? We could have taken the senior bond again, but basically again, there is no news on this company. Both bonds correct, but the perpetual bond gives you much more upside because basically there is no news on the company, it's just the election of Donald Trump. And you see, once people realize this, the perpetual bond, they rally much more than the senior bond. This is the price difference. So you see that the price difference decreases. The perpetual bond does much better than the senior bond. Here is the news that the government is in talks with Telefónica to increase the capital. So they are solving the problem. There is a first signal that they are solving the negative equity problem. Here is the local news papers that report that effectively Telefónica and the government will increase the capital of the company. So we increase our position from 1% to 2%, the market realizes it, and the bonds jump about 7%. Very nice trade. Here we sell our position. Why? Again, we are in emerging markets, and anything can happen at any time. We sold a little bit too early, because you see that the perpetual bond continues to rally, but here you have exactly the governance thing, where the government of Colombia says, oh, you have a license in 1994, and you still need to pay for this. So they impose a fine of $500 million on Telefónica, and you see that the perpetual bond drops again from about 104 to 92, so a 10% loss. Again, we are not invested in the security at this time, and it shows that we are right here to reduce our position because there can always be happening something. We did not reinvest there because we were not sure how Telefonica would react on this news. Ultimately, they did increase the capital and the bonds are now back on par, but we did not have this last position. So these are two examples. This is all very nice, but what does it actually is the output? And so we say we offer decorrelation in this fund, and what you see here is our peer group, and you see the upside-downside capture. So what you see on the x-axis is a total return when the benchmark has a negative return. So when the benchmark has a negative return, we also have a negative return, but the benchmark has a negative return of around 1% in that month, whereas we have a little bit more than 0.5%. So we outperform the benchmark when the benchmark goes down. When the benchmark goes up is the y-axis. We do more than the benchmark, so we have about 2% return when the benchmark goes up. The benchmark has about 1%, so we do about double the benchmark when the benchmark goes up, and we do better when the benchmark goes down. So we are truly decorrelated. Basically, this is the space where you want to be, and you see that there are very few funds that are actually there. This is normal, actually. This is what you get if the benchmark goes down, you go down less, you have a little bit less risk. If the benchmark goes up, you go up more. But this is, you go down less and you go up more. And this is very interesting, and it shows that we truly offer this decorrelation to our clients. Another obvious question is, of course, yes, you have the same process. We have the sovereigns, we have the corporates. So does it matter? Does it matter that we invest in the corporates or in the sovereign? Are they the same or not? And so what you see here is two correlations. This is the index correlation, sovereign versus corporates. It's relatively high. It's close to 1. This is the fund correlation, so the sovereign fund versus the corporate fund. And so you see that the correlation is about 0.6. Today it's a 6-month rolling correlation. It was higher. Why was it higher initially? Because initially the fund, at the beginning of 2016, there was a lot of risk aversion in the market. And so there were a lot of opportunities on the quasi-sovereign side, so you didn't need to go to event-driven stories really to generate good return for your clients. So how does the fund look like? So we, of course, aim to achieve returns in excess of the benchmark. Our tracking error is not that big. It's about 3% ex ante. We have hard currency corporate exposure, sovereign and quasi-sovereign a little bit also for liquidity. We are really credit managers. We don't play duration very actively. We have currently a half a year short duration because we think the rates will go up, but it's not that we very actively play this duration. It means that we have a short bias. If we take position in non-dollar, we will systematically hedge it. And we have a high turnover. Because of this event-driven opportunities, they need also to dynamically assess the positions you have. If we look at the income, so this is end of November, we have about 8.7% yield to maturity. Duration, as I said, slightly short. Spread duration, slightly long, so we prefer longer dated bonds. Very interesting, I think, is the spread. The spread is about 3 times as large on the fund than on the index. We have high conviction with 100 positions, more or less, and we have a slightly lower rating because sometimes these event-driven opportunities are low rated. So if we conclude on the emerging markets part, as we indicated with the governance, we believe that emerging markets offer a structural risk premium because of weaker governance, among other things. As Luc indicated, we have improving fundamentals, technicals, and still attractive valuations. Market segmentation and irrational behavior create mispricings. They can be exploited by contrarian and value-based investors. We have higher spread without deteriorating the average credit quality on the sovereign side. And of course, this wide investment universe creates a broader and recurring high alpha. Event-driven, I think, is very important, create pure alpha and diversification to your portfolio. And we have superior performance relative to the peer group. This is emerging market debt. Very briefly, the performance. I think very important is, I think since inception, we have about 7% annual return after fees versus a slightly less than 6% for the benchmark. And this you can see here. So we have quite good ratings by Morningstar. This I will skip. This is versus peer groups. And this is the corporate fund. Also here we have about double the return on the benchmark since inception. So the fund exists since 2 years. Since inception, we have about 18% on average versus 8% on the benchmark. So this is, of course, very good. The fund has now 2-year track record and slightly below 120 million assets under management. And this is versus the peer group, so we clearly show that we have very excellent returns in this fund. And with this, I give the word to Matteo.
Grazie.
Sì, rieccomi. Allora, complimenti intanto.
So, I'm back. Congratulations for the patience that you have shown in the audience. So the topics we dealt with were particularly appealing. I realize it because the audience was very silent and attentive. So what have we learned in this session? We have tackled many different topics. We have summarized in 5: low interest rates. Income will still be a strong focus for investors. Governance is important. But I have added some others, because, you know, it's a wonderful topic, and because then we'll have to do the Q&A. So low inflation, number 2, interest rates in America, we were told at the end of next year will be around 240 to 70%. 3, we will have more Europe, and this is a great piece of newness compared to what we knew. And then number 4, it is possible to have a convergence of peripheral euros. You see, there's a lot of fear in the Italian electoral time, but the peripheral euros could converge towards the returns of Eurocentric securities. And then expansions, they never die of old age. They have to really crush them with some external factors. And this is also important. So will economic growth last long? Yes. And it will keep growing until something coming from the outside crushes it. And the secret of bond investments, it lies in coupons. Let's not think about spreads all the time. Coupon, that's the secret. And another good piece of news, Italian banks are healthy and fit. We had always been accused to be the weak link in the European system. Now we are finally fine. And this is another good piece of news, considering that Swiss investors are talking, because they're very attentive to the risk they take. Then the global corporate market has increased in a healthy manner, with just a few defaults, with interest returns. And also the perception for investors is much more important than facts. So the perception of a good or bad governance actually can play out very well or bad for investors. We saw it in the example of Telefónica Colombia in Spain. Unfortunately, Telefónica Colombia is owned by Spain 70%. So we pay a premium because we have the perception that it is riskier. Then many flows in emerging debt, in emerging markets, but most investors are still underweight. So let's not worry about flows. Valuations are interesting. Recovery rates of EMs are very high. They have learned how expensive it is not to abide by or not to respect bondholders. Investments in EM is not just a question of decreasing spreads. There is trade value to be taken into account and event trade. These were the highlights, the takeaway messages. And now the questions. I will try and be brief. So the biggest worry is that of the Fed policy, had to do with the Fed policy. On the one hand, we wonder, and this is the first part of the question, I'll ask Mr. Monda to answer. If inflation is low, if everybody thinks that the Fed will increase interest rates by 2-3 times, why is that? Point number 2, and this question is for Wouter and Luc. This time, a tightening policy by the Fed, to what extent could it impact the emerging market asset class?
First question.
The first question is, you think that inflation and why Federal Reserve, if the inflation is low, should increase rates 2-3 times this year?
Well, if they want to normalize in case we see a downturn, so they have a bit of ammunition to basically reduce interest rates, at the next downturn. Let's not forget rather that we have an expansion, but it's still fragile. But the Fed is not going to increase rates a lot in the end. I mean, if you look at the long run dots, it's at 275. It tells you that they want to have long-term rates at around there and anchored there. So really, where are we today in the Fed? 125 to 150 to get to 275. We need what? Maybe another 4 or 5 hikes over a period of maybe 2-3 years. They want to normalize a little bit, basically, to be prepared in case they face a downturn. A downturn will come at some stage. We don't know exactly when, but it's not in the cards for 2018. That's the only reason why they keep basically being very gradual. That's the answer.
And the impact on emerging market of this tightening? Can happen something similar to 2013? Cioè può succedere qualcosa simile al 2013?
It can, of course, but I don't think it's very likely. As long as the Fed moves a bit in the speed that you suggested, in the speed that the market expected, not much is going to happen with the EM. That has an effect on US yields. Probably the treasuries will go slightly higher, and at the same time, to a smaller extent, but probably the spread will decrease to some extent. So that's really that's a benign scenario. That's not a problem at all. Of course, there's some experiments in the US, like very late expansionary fiscal policy, which is never done, and if that derails, you could get a Fed that needs to move much quicker, and you can get a panic in the market. What really happened in 2013, panic in 2013 was unjustified. You can get again an unjustified panic, but I think the chances are rather low to see that.
C'era un'altra domanda sul rendimento complessivo.
Another question on the overall return or yield of both instruments on the dollar. So on the one hand, we are asked, what about the exchange rate of the dollar? And if the dollar was to weaken, what kind of return would this mean for investments, especially for the emerging and global corporate investments?
Well, it depends how you buy the fund. So the dollar will not have much effect on the return, because you can buy this fund in a euro hedged share. Then I don't think there will be major moves in the asset class because the dollar moves. Of course, if you invest in the dollar and share, and you have a dollar risk, so if the dollar goes down, you'll suffer from it. But that's why you can go for other shares. Of course, your nominal return will be slightly lower in euros, because when we hedge it, we lose a little bit of interest rates. Your final return will mainly depend on how the euro moves versus the dollar. That will definitely be different between the two.
A similar answer for global corporates. I mean, in the portfolio, everything is hedged back to the reference currency in the fund. So I don't want to take currency risk in the fund. And then depending on your needs, if you want to invest in the euro share class, also the euro share class is fully hedged. So there's no currency risk other than what Luc just described.
Okay. Una domanda sul sempre
a question on the corporate world, the tax reform in the United States and its implications for investors?
That's a very good question, which I'll try to answer brief because it's a comprehensive topic, the US tax reform. But it's, first of all, good news that it came relatively on time. And we think it has mainly positive implication. And just to highlight you 3 reasons for it. Number 1 is, in general, lower taxes means higher earnings, means higher free cash flow, which is good for companies. Second is, the interest deductibility is limited. That means your incentive as a corporation to use leverage with a higher tax rate is reduced. Or if a corporate treasurer calculates its cost of capital, and the tax experts among you might know that, the tax shield comes into effect. And with the taxes being now at a lower scale, the amount of the tax shield also diminishes or becomes lower. That means overall, a corporation is less incentivized to use debt versus equity than with a higher tax rate. And this over time, not quickly, but over time, we believe, will result in that corporations will rethink their capital structure, meaning using debt versus equity. And that could lead to a lower level of debt in the corporate world in the United States, meaning the leverage comes down automatically by the lower taxes. And third point I want to highlight is the repatriation of foreign profits. You heard about Apple these days announcing bringing back all their money which sits in Europe, European profits, which have not been transferred to the United States because of that high tax rate. They would have applied 35% taxes to that profit, and now it's only 15%. So now companies are incentivized to really bring back their foreign profits to the US. And this is something positive because these profits, they were there, but the companies could not use them. So it was not really something they could use and benefit from that flexibility. So we think the sectors that are involved, mostly tech and healthcare, will hugely benefit from that. And that is also positive for corporations because they need to issue less debt because they have now more cash.
Un'altra domanda era su...
Another question on what products to advise to someone with a low risk profile. This slide shows the risk return ratio from left to right. So corporate bond mid yield, yield to maturity 2.3, global corporate bond mid yield, which should be 3.4%, emerging market hard currency 6.9%, emerging market corporate 8%, and all have a different volatility. Of course, this is the answer. Are there the questions that you would like to ask? I'm asking the audience, who is present here, and the question should be asked into a microphone. I carefully listened to the very first presentation that seemed to me very rational in its approach. But the people's emotions were not taken into consideration because, as it was rightly said, in the US we have a certain precedent that might clash against the Korean precedent one day, and then the inflation is doomed to increase. In my opinion, I repeat, geopolitical aspects were not considered when we talk about inflation rate.
Of course, I mean, if we start seeing the US imposing tariffs on other countries and vice versa, it might create a negative dynamic. But hopefully we are not there. There was some news overnight that President Trump wants to tax solar panels that come from Asia. That's just one small segment, so hopefully it doesn't really transpires to a lot of industries. And then, you know, in the end also, it's also negative for US jobs because, you know, they do export quite a lot. So they would have to adopt, you know, a balanced approach. And if, you know, they become too protectionist, in the end, you know, the US manufacturing sector is not that very well diversified. There's still a lot of manual skills, and the people who have those manual jobs would really suffer if actually, you know, there are more tariffs and more protectionism. So, you know, the job market in the US could start suffering. So they have to be very careful. And if that is the case, you know, the Fed would be extremely cautious, and actually inflation would not pick up at all. So, you know, it's with Mr. Trump and his personality is much more, you know, making the news again, and it's some noise. But we take it into consideration. It's not that we don't watch it. Now, on the geopolitical issues, this is one key where we have risk at the end of the day on the geopolitical front. I don't think we would have too much, in my view, but that's my personal view, I don't think we would have too much issues with North Korea, because at the end of the day, North Korea is China. And to take on China, that might be difficult for Mr. Trump. I think the geopolitical disturbances one day will come from the Middle East. That's very important to watch. Because again, with the new technologies that are evolving and electric vehicles, one could well be in a situation, you know, not immediately, but, you know, in many years, where oil prices are no longer where they are because of the advances in electrical vehicles. And that could create disturbances for the Middle East and, you know, even the US. So we continue to watch that. It might present opportunities as well, but it's not for the immediate future. But as we've shown, you know, expansions never die of old age. You need a shock. Geopolitical risks do exist, and we factor that in. We think about those continually. And if we thought that certain risk would materialize, we would act in the portfolios and go much more defensive, of course.
Grazie, grazie Monica. C'è spazio per un'ultimissima.
Thank you very much. One last question. In the Swiss tradition, sharp on time, we close our session. Thank you very much. Thank you to our guests. You're all invited to our lunch. Thank you very much. Thank you to you all. Thank you.